This lecture, Everyone's Stake in Capitalism, is an abridged version of what was originally Lecture 3 of my 1983 Jefferson School series, Essentials of Capitalism. I delivered it numerous times thereafter, but it was never successfully recorded until now. The lecture that Second Renaissance Books, and later the Jefferson School, sold under the title of this lecture was actually a follow-up lecture, Everyone's Stake in Capitalism, Roman numeral II, which appears in this series under that title. Please be sure to print out and consult the one-page summary that accompanies this lecture. If you purchase the complete program, it appears on the disc labeled Lecture Supplements. Otherwise, it should have been sent to you either on a disc or as an email attachment file. This lecture was the first draft of the material that now appears in the opening sections of Chapter 9 of Capitalism. Good afternoon, ladies and gentlemen. Today, I'd like to develop and elaborate one of the great, profound insights of Ludwig von Mises that I think deserves a lot more dissemination than it's gotten, and which I present in my book in the first part of Chapter 9. This concerns the influence of the division of labor on the institution of private ownership of the means of production. The division of labor, of course, means that the total labor required to support a human life is divided up into separate, distinct occupations. In a division of labor society, the individual lives by producing or helping to produce just one, or at most a very few things, all or practically all of which are consumed by others. At the same time, all, or practically all, of what the individual himself consumes is produced by others. The influence of the division of labor on the institution of private ownership of the means of production is almost universally ignored. Typically, people think of privately owned means of production in terms that would be appropriate only in a non-division of labor society. That is, they think of the privately owned means of production in the same way that they think of privately owned consumers' goods, namely as being of benefit only to their owners. They believe that before the non-owners can benefit from the means of production, they must first become owners. This belief underlies the popularity of all forms of redistributionism and socialism. People believe that so long as wealth remains concentrated in the hands of a relatively small number of capitalists, the capitalists alone benefit from it. For the great mass of non-capitalists to benefit, it is believed, the wealth of the capitalists must first be taken away and given to them, or be held by the government and used for the collective good of all. This idea is present in the criticisms the Democrats routinely make of the Republicans' proposals to cut taxes on the rich. Such tax cuts, which would serve to substantially increase the accumulation of capital by the rich, are assumed to be of benefit exclusively to the rich and to be of no benefit to the general public. Closely related to the idea that private ownership of the means of production and capitalism serve only the interests of the capitalists is the belief that the defenders of capitalism must either themselves be capitalists or be in the pay of the capitalists, or else simply be perverse enemies of the great majority of mankind. So deeply rooted are such convictions that it is often thought to be a sufficient refutation of the arguments of an advocate of capitalism to suggest the size of his bank account or stock holdings. Similarly, in reporting election returns, the news media routinely explain votes for relatively pro-capitalist candidates or policies on the basis of the voters' high income and wealth status, and take for granted that the interests of the great mass of non-capitalists are served by anti-capitalistic policies. They are greatly surprised any time a pro-capitalist candidate does well in a blue-collar or working-class district, because they assume the voters there are voting against their economic interests, inasmuch as they are not capitalists. Even the alleged friends of capitalism often share the conviction that private ownership of the means of production serve only the capitalists. For example, during the so-called Cold War, their notion of how to fight the spread of communism was first to create more capitalists. Only to that extent, they believed, would people have a self-interest in the existence of capitalism and thus in combating the communists. And where some faint glimmering of the idea may exist, that perhaps leaving the wealth of the capitalists alone might actually make everyone better off, a horde of skeptics rushes in to denounce what it calls the, quote, trickle-down theory, unquote. Well, the first thing that should be realized today is that in a division of labor society, all private property that is in the form of means of production, that is, of capital, serves everyone, non-owners as well as owners. In a division of labor society, the means of production are not used in producing for their owners' personal consumption, but for the market. They are used in producing goods that are sold. The physical beneficiaries of this private property, and it is the far greater part of the capitalist wealth, are all those who buy the products it helps to produce. In other words, it is the general buying public who are the physical beneficiaries of the capitalist capital, of their wealth that is in the form of means of production. Consider, for example, who are the physical beneficiaries of the auto plants of General Motors? That is, who physically receives the products of those plants? Is it the stock and bondholders of General Motors? No, of course not. The number of GM's cars that is produced for the capitalists who own GM is relatively insignificant. Almost 100% of General Motors' auto output goes to people who may very well not own even a single share of its stock or a single one of its bonds. The same is true of every other business enterprise. The simple fact is that in a division of labor society, one does not have to own the means of production to get their benefit. One only has to be able to buy their products. In a division of labor society, one gets the benefit of means of production owned by others every time one appears in the market as a customer. Indeed, it is in the very essence of a division of labor society that one obtains the benefit of the means of production owned by others, just as one obtains the benefit of others' labor, and that this occurs by means of the purchase of products in the market. To say all this in somewhat different words, there is a general benefit from the capital owned by the capitalists, a benefit which everyone shares in his capacity as a buyer of products, even if he himself does not own any capital. Indeed, if we are to acknowledge the truth, we must go further and recognize, as von Mises did, that the general buying public not only benefits from the means of production owned by the capitalists, but exercises real and decisive power over the ways in which the capitalist means of production are employed, because, by its pattern of buying and abstention from buying, the public determines which products it is profitable to produce and which it is unprofitable to produce. It thus places the capitalists in a position in which to make profits and avoid losses, they must produce what the public wants to buy, and abstain from producing what it does not want to buy. In a division of labor capitalist society, it is thus ultimately the consumers who determine the pattern of production, including the relative size of the various industries, and even the specific methods of production used in every industry. This last comes about because the demand of the consumers determines the relative prices of the factors of production, such as the wages of skilled labor versus unskilled labor, or the price of copper versus the price of aluminum, and thus which methods of production are more economical in any given case. Now there are in fact two aspects of the general benefit from the existence of the capitalist capital. The first of these is the one I have just explained, that of the buyers of products benefiting from the capital that helps to produce those products. The second is in connection with the fact that capital constantly appears in the market as a demand, expenditure, by the capitalists for means of production, including labor. The capitalists begin their productive activities with outlays of money for labor, materials, and equipment. The revenues they subsequently take in from the sale of the products they produce are then almost entirely re-expended in the form of fresh outlays for labor, materials, and equipment. These outlays of the capitalists for labor are what make possible the purchase of consumers' goods by non-capitalists. They are the source of the wage earners' incomes. It should be obvious that the more economically capitalistic the system is, in the sense of the capitalists expending a larger proportion of their sales revenues for means of production and a smaller proportion on their own consumption, the higher will be the income and consumption of wage earners in comparison with the consumption of the capitalists. In other words, the more the capitalists abstain from consumption in order to accumulate or maintain their capitals, the larger is the share of the economic system's output of consumers' goods that goes to wage earners, and the smaller is the share that goes to capitalists. There is a conclusion that follows from all this, which will appear highly paradoxical to many people, but which is nonetheless perfectly logical and correct, and that is that the more the private property rights of capitalists are respected, the greater are the benefits to non-capitalists, because then the capitalists will be encouraged to save and accumulate capital. Their own consumption will be small in relation to their capital, and will grow only as their capital grows. In each year, the demand for labor will be correspondingly larger, because of the capitalist's greater saving, and the share of consumers' goods purchased by wage earners will likewise be correspondingly larger. Also, of course, the more the property rights of the capitalists are respected, the more powerfully do the incentives of profit and loss operate to make the capitalists satisfy the demand of the consumers. Because, for example, the profits of doing so are correspondingly less diluted by taxation. By the same token, the losses of failing to do so are not offset by reduced tax payments on other profits, nor are they compensated for by subsidies. In addition, respecting the property rights of the capitalists means leaving them legally free to enter any area of production they wish. It thus means the freedom of competition. And it also means not imposing on them laws and regulations that arbitrarily raise costs of production and prices, such as compulsory bargaining with labor unions, zoning laws, government building codes, product safety regulations, and environmental regulations. All such laws and regulations are actually at the expense of the consumers, because anything that arbitrarily raises costs of production raises prices and provides no adequately compensating benefit to the consumers. Now, what is even more important in the long run is that if the capitalist property rights are sufficiently respected, then from year to year the total production of consumers' goods available to everyone tends to increase, and thus the purchasing power of everyone's income tends to rise. What I am saying now is that in a division of labor capitalist society, not only is there a general public benefit from privately owned means of production, but that benefit tends steadily to increase. It tends to increase precisely because of the saving and capital accumulation, the profit and loss incentives, and the freedom of competition that respect for the institution of private ownership of the means of production creates. Let us consider first the role that is played by the capitalists' saving of their sales revenues. The larger the proportion of sales revenues saved and productively expended, that is, expended for means of production rather than consumers' goods, the higher is not only the demand for labor relative to the demand for consumers' goods, but also the demand for capital goods relative to the demand for consumers' goods. In other words, the greater the degree of the capitalist saving and productive expenditure, the higher not only are wage payments and the consumption spending of wage earners relative to total consumption, but also the expenditures for capital goods relative to consumer spending. This has a vital bearing on economic progress. The ability to implement more advanced technologies, and thus to raise the productivity of labor and the general standard of living, depends on a growing supply of capital goods being put into the hands of the average worker. More advanced technologies almost always require the use of equipment and materials representing a larger quantity and or improved quality of capital goods than the less advanced technologies they replace. For example, an up-to-date factory of almost any kind represents far more wealth and capital in terms of quantity and/or quality than its less advanced counterpart of a decade or generation ago. This is true to an important extent even in the case of today's mini steel mills, which are noted for greatly reducing the size of the investment needed to produce various types of steel. Those mills would not have been possible without major increases in the supply of such things as computers and computer chips, and without the underlying development of the computer industry, and I believe of factories turning out fiber optic cable and robots. Now, in order for the supply of capital goods to grow from year to year, it is necessary that the current production of capital goods each year exceed the using up and wearing out of existing capital goods. Capital goods are used up and worn out in the production both of consumers' goods and of capital goods. In order for an economic system merely to stand pat, to remain stationary, it must devote to the production of capital goods a proportion of its overall ability to produce that is sufficient to replace the capital goods it consumes. If it is to progress, it must devote to the production of capital goods a larger proportion than this of its overall ability to produce. If it fails to devote to the production of capital goods even the proportion of its overall ability to produce that is required to offset capital consumption, then its supply of capital goods falls, and its ability to produce falls. It retrogresses. What I mean when I talk of the proportion of an economy's overall ability to produce that it devotes to the production of capital goods is simply this. At any given time, the economic system has some definite overall ability to produce. Within broad limits, this ability can be devoted either to the production of capital goods, like diesel locomotives, trucks, and factory buildings, or it can be devoted to the production of consumers' goods, like passenger automobiles, refrigerators, and houses. In order for the economic system to progress, it is necessary that a sufficient proportion of its productive ability be devoted to the production of capital goods, like diesel locomotives and so on, so that it begins each year in the possession of a larger supply of such goods than it began the year before. Now, what determines the proportion in which the economic system's existing ability to produce is devoted to the production of capital goods rather than the production of consumers' goods is the demand for capital goods relative to the demand for consumers' goods. For example, what determines the extent to which General Motors devotes its existing resources to the production of diesel locomotives and trucks relative to passenger automobiles, and what determines the relative prosperity and growth or decline of companies exclusively producing the one or the other type of good, is the relative demands for these goods. And what determines these relative demands is the extent to which people save and expend their savings for business purposes relative to the extent to which they consume their funds. To return to our starting point, the greater is the share of the capitalist sales revenues that they save and productively expend, and the smaller the share that they consume, the greater is the demand for capital goods relative to the demand for consumers' goods, and thus the greater is the production of capital goods relative to the production of consumers' goods. If the property rights of capitalists are sufficiently respected, they are motivated to save enough so that the relative demand for and production of capital goods is great enough to achieve capital accumulation and thus to make possible economic progress. Now, the profit and loss incentives and the freedom of competition that respect for private ownership of the means of production makes possible act no less powerfully to steadily expand the supply of goods coming to the market and promoting the material well-being of everyone in a division of labor society. Under the freedom of competition, the only way for a business to earn an exceptional rate of profit is by being a leader in the improvement of production. It must introduce new and improved products, or more efficient, lower-cost methods of producing existing products. Or it must be a leader in meeting changes in consumer demand, inaugurated for the most part by economic progress. If it does this, it expands its sales revenues and profits at the expense of the sales revenues and profits of other firms that are less quick to improve. For it has something better or equally good but less expensive to offer than they do, and so buyers shift their purchases to it. Now the combination of an innovator's higher profits and others' lower profits or outright losses is what then impels others to improve their production too. These others may simply want to cash in on the high profits of the innovator and so duplicate or improve upon his innovation for that reason. Or they may be in the position of having to duplicate his innovation in order merely to stay in business. Please observe that under the freedom of competition, innovations must be adopted not only to make exceptional profits, but to be able to make any profits whatever. They must be adopted merely to be able to remain in business at all, because sooner or later, as the result of the freedom of competition, the cost cuts resulting from innovations are translated into price cuts, and whoever does not produce with the lower cost methods cannot cover his costs. Even in a highly inflationary environment, in which wages rise substantially every year, and the great majority of prices also rise, it is necessary for all producers to adopt cost-cutting improvements. They must adopt them in order not to have to raise prices in full proportion to the increase in wages, and so be in the untenable position of requiring price increases greater than their competitors in order to stay in business. There is probably no business in the United States today that would still be in business had it not adopted major innovations over the last generation and probably even over the last decade or less. It is not possible for a business to sell at the same prices as others and yet produce at substantially higher costs, not when its selling prices are governed by their lower costs. Nor is it possible for a business to sell a substantially poorer product than others at the same price they are asking for a better product. The penalty of falling too far behind, either in efficiency or in quality of product, is going out of business. The only way to avoid this penalty is by adopting the innovations before it is too late. Now, the fact that sooner or later competitors do adopt innovations not only enables them to increase or restore their own profitability, or at least to survive, which of these it is depends on how much sooner or later they adopt them, but it also takes away the special profits of the innovators. The more general an innovation becomes, the more it becomes the normal standard of an industry, the less can any exceptional profit be made from it. For example, at one time, Henry Ford was able to make an exceptional rate of profit because he produced automobiles on a moving assembly line and used interchangeable mass-produced parts. When those methods of production became standard and the price of automobiles came fully to reflect their use, no special profit could any longer be made from them. Today, of course, the requirements for mere existence in the auto industry far surpass anything in Ford's day. The fact that the special profits of innovating do tend to disappear because competitors catch up has the further effect of requiring that everyone who wants to go on making an exceptional rate of profit over an extended period of time must introduce repeated innovations. If he is to prevent the loss of all of his special profits to competitors who are catching up, he must make fresh advances over them. In this way, the combination of the profit motive and the freedom of competition leads successful producers to seek continuous improvements. That is the only way they can sustain an exceptional rate of profit. They cannot rest content merely with their past successes. In connection with the freedom of competition, it should be realized, moreover, as von Mises always stressed, that the ranks of the capitalists are open to everybody, including penniless newcomers. Those who have a valuable idea but lack the funds to implement it themselves can offer a partnership to others who do have capital, and further capital can be borrowed. In a division of labor capitalist society, there is an enormously large number of possible sources of financing for any new idea. It is equal to the number of individuals or combinations of individuals who possess the amount of capital required. For example, if $1 million is the sum required, there are as many potential sources of financing as there are individuals or combinations of individuals who possess $1 million or more. This situation guarantees that every new idea has many possible chances for being implemented. If the innovator does not possess the necessary capital himself, he can turn to as many separate sources of financing as there are individuals or groups who do possess the necessary capital. It is not necessary for him to convince everyone, a majority, or even a substantial minority of his fellow citizens that his idea is valuable before he can put it into practice. If he owns the necessary capital himself, he can go ahead without convincing any other person at all. If he does not own the necessary capital himself, then he needs to convince only a minority consisting of possibly just one other person, and in no case more than a relatively very small number of people, who in combination possess the necessary capital. Thus, the institution of private ownership of the means of production in a division of labor capitalist society provides the incentive of profit to introduce continuous innovations, the incentive of avoiding losses to keep up with the innovations of competitors, and opens the possibility of introducing innovations to everyone in the entire society. It is impossible to imagine an economic institution and an economic system that could be more conducive to economic progress. I would like to point out the further very important fact that the incentive of profit and loss and the freedom of competition have a vital bearing on the ability of the economic system to accumulate capital. The more powerfully they operate, the more they increase the amount of production, including the amount of capital goods, that can be obtained with any given amount of existing means of production. To the extent that the amount of capital goods that can be produced from the same factors of production is greater, the lower is the proportion of the economic system's efforts that is required to offset its consumption of capital goods, and thus the more rapidly it can accumulate capital goods by devoting any given larger proportion of its efforts to their production. Thus, whatever promotes economic efficiency, above all economic freedom and respect for property rights, promotes capital accumulation. We have seen the general benefit, the increasing general benefit, that everyone, capitalist and non-capitalist, large capitalist and small capitalist, derives from the institution of private ownership of the means of production in a division of labor society. We have seen that in a division of labor society, everyone benefits from privately owned means of production who buys their products, or who is employed by means of the capital that they represent, and that the employment of capital is in fact ultimately controlled by the buyers of products. We have seen how respect for private ownership of the means of production promotes saving and capital accumulation, how the more the property rights of the capitalists are respected, the higher are wages and the consumption of wage earners relative to the consumption of capitalists, and how the supplies of capital goods and the purchasing power of everyone's income are made to increase and to go on increasing through the combined operation of the incentives to save and invest and to make profits and avoid losses, and the freedom of competition. I now want to consider the special benefits derived by the capitalists from their ownership of capital. Obviously, no matter what gains their capital provides for non-capitalists, it is better to be a capitalist than a non-capitalist, and better still to be a wealthier capitalist than a poorer capitalist. What precisely is the nature of these special gains that the capitalists derive from their capital that is over and above the gains that everyone else derives? There is undoubtedly a temptation to answer, the capitalists earn profit or interest on their capital, which the rest of the society does not, and that is their special benefit. This answer is mistaken. It is true that only the capitalists earn the profit or interest on their capitals, but to the extent that they save and invest their profits or interest, the profits or interest provide the same kind of general benefit as their original capital. That is, they represent additional means of production serving the general buying public and additional wage payments. As I see it, there are two gains that the capitalists receive which others do not. The first is the portion of their profits and interest that they do not save and invest, but consume. Even this overstates their special gains to the extent that their consumption includes things like support of universities, libraries, and opera companies, because here again are general benefits. The second is the psychological value that the possession of capital has. To the extent that one possesses capital, one has the potential of consuming it. One thus has the psychological security of knowing that one could consume it if one had to or wanted to. Now, so long as the institution of private ownership of the means of production remains secure, this advantage of owning capital usually remains strictly psychological. That is to say, the potential the capitalists have of consuming their capital usually remains just that, a potential. The capital itself is generally not consumed, but left invested, and upon death it is passed to heirs. In part, this is because capitalists who are in business regard the possession of their capital as essential to their livelihood. Significant-sized capitalists, moreover, whether they are in business or not, are likely to regard the possession of their capital as being the means by which they can live for the remainder of their lives and provide for their children and grandchildren. In today's conditions, significant-sized capitalists can be taken to mean those with a capital of, say, 2 million or more. As a result of these facts, the major instances in which the consumption of capital occurs is when the rate of profit or interest that is earned falls to the point that it cannot provide the standard of living the capitalists feel they can afford on the basis of their accumulated capital. In such circumstances, they encroach upon their capital. Even then, they generally do so only to a relatively modest degree, because they require the great bulk of their capital as the means of providing for their future needs and wants. This, of course, is apart from instances in which business or investment losses are incurred, which the capitalists certainly strive to avoid, but which are capable of wiping out one's entire capital and more. On the basis of this and previous discussion, it should be clear that if the institution of private ownership of the means of production is secure, the actual consumption of businessmen and capitalists, whether out of current profits or interest, or out of capital accumulated out of past profits or interest, is minor in comparison with wages and the consumption of wage earners. This is especially true of the consumption of significant-sized businessmen and capitalists, who own the great bulk of the capital of the economic system, and who earn most of the profits and interest in the economic system. In fact, in a country with the degree of security of property that was historically enjoyed in the United States, the consumption of the significant-sized businessmen and capitalists, including whatever great mansions and ocean-going yachts and caviar and champagne they might consume, would most likely amount to not much more than about 10% of the total consumption taking place in the economic system. This is because the mansions and yachts and the suppers of caviar and champagne in their hundreds and thousands pale into insignificance alongside the consumption of wage and salary earners in their tens of millions, enjoying ordinary houses and automobiles, and even just hamburgers and Coca-Cola. The preceding facts about the capitalist's special benefit from the institution of private ownership of the means of production have an important bearing on the appraisal of demands for the redistribution of wealth and income, and for socialism, insofar as socialism is advocated as a method of redistribution. For after all is said and done, it is something on the order of a mere 10% of the overall total consumption of the economic system that turns out to be the grand prize for which the redistributors and socialists have been clamoring all these years. This is the great fund of wealth by means of which they have expected to abolish all poverty, cure disease, and achieve utopia, and for the sake of which they have been ready to overturn existing society, seize private property, and shed rivers of blood, all in magnificent obliviousness to the fact that capitalism itself gratuitously provides such wealth and income over and over again every few years through economic progress and its accompanying improvement in the productivity of labor and real wages. Indeed, if the 10% or so of the total consumption that is accounted for by the consumption of the significant-sized capitalists is divided by the 90% of consumption that already takes place on the part of the rest of the population, the resulting 11% ratio would be made good for the rest of the population over and over again, approximately every 5 years, through a rate of economic progress of just 2% per year. These points need to be emphasized in order to understand the actual nature of the demands for redistribution and socialism. The conclusion that follows from them is that even if the redistributors and socialists could succeed in expropriating the capitalist wealth without causing the destruction of that wealth or of its productivity, which of course they cannot, the utmost that they could obtain for the benefit of the average person that he would not already have is his share of the approximately 10% of total consumption that is accounted for by the consumption of the significant-sized capitalists. And this, of course, would be a one-time only, non-repeatable benefit. This would be the limit of the benefit, because anything beyond it would represent capital decumulation. Obviously, even if it could be obtained, such a benefit would not be worth making into the leading objective of a political philosophy and movement, let alone fighting a revolution for. But the fact is, of course, that no such benefit can be obtained. The attempt to seize the 10% can only inflict injury on those intended to benefit from the seizure. It must deprive them both of all the vastly greater future gains they would have had from the continued operation of capitalism, and all of the gains they have already obtained from it up to that moment. For the capitalists cannot be forcibly prevented from consuming without losing interest in the management of their wealth and in its accumulation in the first place. Their wealth is valuable to them only insofar as it serves as a source of actual or potential consumption for them or their heirs. To the degree that their ability to consume is forcibly restricted, the value to them of their wealth is destroyed. For example, a forced limitation of a capitalist's consumption to some fixed amount, such as $100,000 per year, would make all that portion of his capital valueless to him that was beyond what was required to provide such an income and consumption. If, for example, a capitalist had $10 million of capital, and the rate of return on capital were 5%, he would lose interest in the management of most of his capital in excess of $2 million, since it would no longer be able to contribute anything to his life and well-being, and he would have no motive to accumulate such capital in the first place. If his consumption in his capacity as a capitalist were totally prohibited, then he would have no motive to maintain his capital at all. The socialization of the means of production would follow as a logical step in response to the destruction of the capitalist's incentives to accumulate and maintain capital. And that, of course, as von Mises explains, and as I explain in Chapter 8 of my book, Capitalism, would also mean the collapse of production. Similar reasoning applies to proposals to limit the after-tax income of capitalists to some fixed amount, such as was advocated years ago by Eleanor Roosevelt and the Union leader Walter Reuther. The enactment of such a proposal would first be accompanied by a decumulation of capital, to the extent that the capitalists considered their existing wealth sufficient to enable them to consume in excess of their statutorily limited income. For example, a limitation of after-tax income to, say, $100,000 a year would not stop capitalists from consuming in excess of $100,000 a year, so long as they judge their capitals to be sufficient to provide such consumption. Such a limitation of income would obviously have to be followed by a limitation of consumption, and then by the government's taking over the management of capital as well, for the reasons just explained. The destructiveness of redistribution is evident in the very size of what the redistributors expect to accomplish and believe to be available as the means of accomplishing it. As they describe matters, what is available for raising the standard of living of the masses is not the relatively modest consumption of the capitalists, but the whole of the capitalists' existing wealth. The propaganda of the redistributors and socialists depicts the capitalists as rich, fat men, whose lauders are overflowing, while the plates of the poor are empty. It demands that the capitalist's wealth be shared for purposes of mass consumption. Since in reality the wealth of the capitalists is in the form of factories and other capital goods, this is a blatant demand for capital decumulation. The poor are to be benefited by consuming the capital that underlies the productivity of labor and the payment of wages, and without which production must plunge. Thus, practically on its face, redistributionism is a policy of destruction. The destructiveness of redistributionism is further confirmed if we consider the specific means which the redistributors advocate for implementing their program, namely government ownership of business enterprises and the progressive taxation of incomes and inheritances, and in non-division of labor societies, land reform. Because of lack of time, I will consider only government ownership of business enterprises. The government's ownership of a business supposedly makes every citizen an equal owner of that business, and in this way supposedly benefits him. Thus every American is supposed to be a 1/260 or 1/270 millionth owner of the U.S. Postal Service, Amtrak, the national parks, and so on. Yet one need hardly do more than name such examples in order to understand the destructiveness of government ownership. The citizen's share in government enterprises does him no good whatever. The fact that the enterprise is government-owned merely means that it is operated without benefit of profit and loss incentives and the freedom of competition. The result is almost always gross inefficiency, high cost, poor service, and low quality of products. The average American is far better and more economically served by the privately owned telephone companies and airlines than he is by the U.S. Postal Service, Amtrak, and all the various municipally owned subway and bus lines. He is much better off dealing with them, even if he does not own a single share of their stock, than in dealing with the government enterprises that are supposed to be his. He is better off dealing with them because they operate under the incentives of profit and loss and the freedom of competition, and thus are motivated to serve him and to serve him progressively better. The adverse consequences of government ownership are, of course, enormously compounded when it goes beyond the case of isolated industries to embrace the entire economic system. Then, in addition to the problems created directly by the lack of profit and loss incentives and the freedom of competition, there are the problems created by the destruction of the price system. The destruction of the price system means the destruction of the basis for economic calculation and for the coordination and integration of the economic plans of individuals. This means the destruction of rational economic planning as such and the consequent disintegration of the economic system into chaos. For details, see von Mises or my book Capitalism, chapters 6 to 8. Putting aside for the moment the consequences of a socialized economic system, as opposed to isolated socialized industries, it is worth noting that government ownership does not provide the alleged citizen owners with any of the special benefits of ownership that exist under private ownership. Government ownership does not give the alleged citizen owner the psychological security that the possession of capital gives to a capitalist. For unlike the capitalist, he cannot sell his share in a government enterprise, nor does he receive dividends on it. In no sense does his alleged ownership provide him with any actual or potential means for consuming and thus for enriching his life. Thus in no way does it provide him with the distinctive benefits of ownership. The destruction of the special gains of ownership also arises in a further way, one that is applicable even in the context of a non-division of labor society. As soon as it is realized that redistributionism is to be a system, people stop accumulating or maintaining their wealth. There is thus very little for the recipients of later redistributions, in quotes, to receive, and what they do receive can give them no pleasure insofar as they know that they themselves will in turn suffer expropriation. In the case of government ownership of industry, the citizen's share not only brings him none of the special gains of ownership, but on the contrary is almost always a liability to him, in that government enterprises almost inevitably incur deficits, which he, the average citizen, must make good through his taxes. Government-owned enterprises incur deficits precisely because it is the taxpayers who must make them good, under coercion. The administrators of the enterprises do not suffer any losses out of their own pockets, nor are they appointed or removable by those who do suffer the losses, the taxpayers. At best, they are appointed and removable by elected officials. But when it becomes one of the powers of government to own and operate business enterprises, these officials owe their election and their prospects for re-election to promises to favor some groups at the expense of other groups. namely large and vocal groups at the expense of small and quiet groups. The individual taxpayer is smaller and quieter than any group, and thus he ends up as the principal victim of pressure group warfare. The politicians and the bureaucrats they appoint are free to use the government enterprises to provide costly vote-buying services, in quotes, and to have them operate with inefficient methods of production, which also buys votes by providing employment and lucrative contracts for pressure group members, and he, the taxpayer, must keep still and simply cover the losses. Thus, the average citizen is a loser in his dealings with government enterprises, not only in his capacity as a consumer, but also, however ironically, in his capacity as an owner, in the very capacity in which he was above all supposed to benefit. He is a loser both ways, and of course the magnitude of his loss grows exponentially as the economic system approaches full socialization. The inescapable conclusion that follows from my discussion is that, as von Mises so clearly saw, the institution of private ownership of the means of production serves everyone, non-owners as well as owners. The real material self-interests of everyone lie with capitalism, not just the interests of the capitalists. An individual is far better off as a non-owner of the means of production under capitalism, just being able to earn wages and buy the products of the means of production, than he is as an equal owner of the means of production under socialism. For in his capacity both as a wage earner and as a consumer, he obtains the benefit of the means of production owned by others. In a division of labor capitalist society, others' means of production are the source both of the demand for his labor and of the supply of the goods he buys, and his benefit in both capacities is the greater, indeed becomes progressively greater, the more the property rights of those others are respected. Thank you.